balancing kind of reading and education and mentorship with taking action, it takes a lot of internal drive to get to any meaningful goal. And I think that's probably the most important saying or quote or whatever you want to call it, mantra.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you are enjoying the show and getting some great value, let us hear about it. Leave us an honest review and give us some feedback. And if you haven't already, make sure you hit that subscribe or follow button so you don't miss an episode. We got a great show today. We're going to be talking to a returning guest, Mr. Travis Watts. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the mastermind button today. Travis Watts is a full-time LP investor and the director of investor development at Ashcroft Capital. Now, he has invested in 50 plus deals as an LP. He's retired with passive income, and he now is a real estate professional, helping others find the same exact value from commercial real estate investing. Let's welcome to the show, Travis Watts.
Hey, John, thrilled to be here. Thanks for the invite back.
Absolutely. Travis, great to have you on. Listen, I gave a little bit of a background on your bio, but why don't you take 2 minutes and fill in some of those gaps?
Yeah, sure. Happy to. So I think like a lot of real estate investors, it got started with active real estate, right? It was just the single family home route, do it yourself stuff. I did fix and flips, vacation rentals, had a few buy and holds, and I did that stuff for about 6.5 years. And I was trying to balance, a full-time career at the time, and I was working in oil and gas. So I was doing 14-hour work days, 98 hours per week, and you can imagine what little time I had to spare, right? So it was kind of a recipe for disaster, and I ended up burning out. And it was about 2014, 2015 that I started networking more. I started joining some local real estate meetup groups out in Colorado where I lived at the time. And there was 2 gentlemen who had sold their companies in the mid 90s, and ever since they had become what they referred to as full-time limited partners. Now, I had no idea what that meant, and I didn't know what a syndication was, and I never even, thought about commercial real estate because I just assumed you'd have to be a mega multimillionaire or a billionaire. Like, I didn't know how that stuff worked. It was all Wall Street or something. So started to slowly transition that way once I saw that basically I could be a full-time passive LP, and I could get the same types of returns and tax benefits and equity upside and cash flow without having to do all the work. And so that's kind of what I really needed to hear and see. And so I started transitioning that portfolio over about 18 months, from liquidating all my single family homes and then coming into the space as a full-time LP. That was the point where I had more cash flow than I had lifestyle expenses, which allowed me to leave that oil and gas job that I really didn't like. And I started giving back to others, teaching them the game and showing other people that this is a real viable solution. This is a real asset class, and it's not too good to be true, and all that good stuff. And so 2019 rolled around. I'd done a lot of deals with a lot of operators, and I came on board with Joe Fairless and Ashcroft Capital, one of the groups I'd been investing with for years at that point, and just helped them out with investor relations, investor education, just getting out there on the podcast circuit, webinars, in-person workshops, property tours, all that good stuff. So that's really what I do today, is serve others in that capacity. And like I always like to say, financial independence doesn't have to mean that you stop working. You think about some of the biggest name investors in the world, or let's just say in the US, you've got Warren Buffett, you got Carl Icahn, you got George Soros, you got Peter Lynch. All these guys have continued working into their 70s, 80s, and even 90s, because they fell in love with what they do. They have a true passion for staying active in some capacity, but of course, having financial independence to back them up. So something to think about, but that's kind of been the journey in a nutshell.
I love it. Travis, let me play some of that back, right? So, first of all, you're grinding away in the oil and gas industry, investing or actively on the side, right? Have some single
Yep.
family rentals and building up your portfolio. And essentially, you just get burned out, working these long days, trying to manage this portfolio, you get burned out. You meet some guys out there in Colorado. They kind of educate you on the opportunity that comes with passive investing. And you have this aha moment, right? Because you didn't realize regular everyday people could invest in these kind of deals. You thought that was reserved for the ultra wealthy, right? You got $100 million net worth or, tons
Yeah.
of capital to put in deals, which you didn't have at that time. So when they introduced this concept to you, you explored it out, had some great returns, invested passively, and ultimately became a full-time passive investor. And I think that's really interesting. And I want to break that down a little bit more, but you became a full-time passive investor. From there, you had worked with Ashcroft Capital and Joe Fairless on a few deals. Down the road, you ended up partnering with them and working with them to continue to grow and kind of help educate other people about these investment opportunities. And I love that point you made. Just because you get to the point where you're financially independent doesn't mean you have to stop working. And I had this notion too, where I think the FIRE movement kind of is just a little bit off cue here because there's this push to just retire early. There's not a push to figure out what you're going to do to help other people, right? There's just this
Yeah.
push to get to the point where you can quit your day job and travel around the world and live like a nomad. And I'm not saying there's anything wrong with that. But I think we have to have a sense of purpose as humans. We have to have a reason to be. We have to help other people. We have to serve other people. And if you don't have that thing, you can still have a void or feel empty. And you find a lot of people end up finding other work just because they need something to do. And it's not that you're bored, but you have a passion for helping other people. You gave that example of, the Peter Lynch's of the world and the other folks who are out there working, not because they need the money, because they enjoy what they do. They enjoy helping other people learn. They enjoy helping other people grow and scale. So that's what you're doing today for Ashcroft Capital. Let's rewind back because you mentioned that phrase full time passive investor, which can sound kind of like an oxymoron to some people. Explain exactly what that means from your perspective.
Yeah, exactly. So that does cause some confusion from time to time. So what that means to me is every single investment that I have in my portfolio, I'm a hands-off investor. Okay, I'm not a GP, I'm not flipping homes, I'm not buying my own real estate and managing it or even hiring a property manager to manage it. This is being a limited partner in private equity syndications. This is investing in other note lending opportunities that are not directly tied to me. It's someone else's fund that does note lending. It could be car washes, mobile home parks, self storage, ATM machines. I mean, it's across the board. There's so many things out there. And little did I know back then that there were so many passive income investment opportunities that exist. So really what my passion is although I do a lot of multifamily residential syndication investing, I do a broad spectrum these days as well. And I'm all for anybody out there choosing any kind of segment to go into. I've been teaching my nephews for years now because they're starting with limited capital how to do this within their own brokerage accounts, and how to choose different ETFs and high dividend investments and things like that. Stuff that ideally would pay them on a monthly basis where they can just stack up that passive income and just grow it and grow it and grow it to the point where they too can have a work optional lifestyle. And I think that's kind of the key is work optional lifestyle to your point. A lot of people are going to continue working. They just may make a pivot. I wasn't a good fit or candidate, so to speak, for oil and gas. I never saw myself there for 20, 30, 40 years. And there was a brief moment in time that I got the opportunity to go work for a very large brokerage house. I got licensed and I wanted to learn stocks, bonds, and mutual funds just so that I wasn't solely biased against real estate. I thought maybe there's something I'm missing. Maybe I need a deeper dive. So I went through that and it was totally optional. Like I didn't have to be there. I didn't have to stay there. I wasn't tied to the golden handcuffs. I did it for pure education and for a broader perspective. And so I could help people in other ways. And I ended up leaving that to go right back into real estate, which I found to be a more powerful asset type. Just my personal opinion, not financial advice, but that was an interesting part of the story.
I love it, man. You talked about making that transition for yourself, being someone who is work optional. you decided to actually go back and get licensed in the equities world and become a broker and work for this brokerage firm just to learn and to make sure that you didn't have this bias towards real estate. And you ultimately did decide that you preferred real estate over the equities world, but you took the time to go out there and get licensed and learned everything you could. You said something a second ago that I thought was really interesting, right? In understanding what it took to become a full-time, passive investor and what that means for you and the way you approach it. For someone who is interested in this approach, like how much do you need to get started? Like what does that situation look like, and how do I know, or how does this investor know that, hey, this is an option for you if you want to pursue it? Is there a minimum amount of capital? Is it like a certain amount of hours you can dedicate? Like, how do you approach that?
It's a great question. And I would say if you're going to be truly a hands-off investor as I am, this is an instance where 99% of the time it does take money to make money. So that's again not how I started. I didn't come from money. I didn't have a trust fund. My parents weren't investors, none of that kind of stuff. None of them were even into real estate. So it came with a mindset shift away from this idea that I'm going to work a job until I'm 65 and I'm going to max out my 401k. I'm going to max out my retirement accounts. And then one day, hopefully between Social Security, assuming it's there, and then all of these types of investments that I can't touch till I'm 59 and a half, that'll be enough to retire. So I started to kind of question that as I had a desire to travel and to have more flexibility, a lifestyle earlier on in my career. So I ended up doing away with all those things. And I started thinking about investing through the lens of yield, okay, cash flow, passive income, whatever term you want to use. And so here's the simple math. Let's just run a basic calculation here. You'll say, okay, I need $100,000 per year to cover my lifestyle expenses, let's just say. So I started looking at it like, okay, if I had 1.25 million invested and I could generate an average of, let's say, an 8% yield annualized, then that would give me 100,000 per year. Now that's a lot different than accumulating this massive nest egg of, let's say, stocks or index funds and then selling off the portfolio when I need the income. A lot of people attribute that to your point of the fire movement of the 4% rule, right? You sell off 4% of your portfolio each year. That creates a little bit of margin for inflation and down cycles and all this kind of stuff. And theoretically, that'll sustain you. I started doing more of like the 8% rule, which is just something I created for myself. It's not advice I give to others. It's just something that's worked ever since 2015 when I kind of made that leap. And the 8% rule suggests that everything that, I'm going to work actively and save some money, I'm going to go put that into an investment. I'm not going to sell the golden goose, the nest egg, right? If I go put 100K out there, I'm protecting the 100K. That 100K is going to produce passive income. I'm going to live off the passive income. I'm going to forget about the equity upside. Tax advantages are great, but it's whatever. And, that's just kind of the icing on the cake, so to speak. When we buy a deal low and we sell high and there's an equity pop, that's awesome. So I pay for taxes and anything in my lifestyle I need to upgrade at that point. But really, it's about living off the yield. And that was just a totally different mindset. And another thing to point out is I think a lot of us, myself included, back when would do these huge goals. I want to have X amount of passive income or X amount of net worth or whatever, that kind of stuff. But to take it in smaller tranches, I'll give you a practical example. What if you diversified among 16 investments and each of those produced $500 a month passive income? That's roughly 100,000 per year. I think it's more like 96,000, but you get the point. So I started looking at it like I'm making progress towards the bigger goal, not just, hey, when I have 5 million bucks, I'll be happy at that point. So that's kind of how I view it, is just step by step and paying attention to passive income and things like the rule of 72, which is how long it takes to double your money just solely through distributions and cash flow. So that's how I invest.
I love it, man. You talked about the rule of eight, the rule of 72 here, and how you kind of play, your portfolio. And the big thing here is it's not necessarily, okay, hey, when I get $5 million, I can retire, or when I'm 65, I can retire. It's really reframing the entire money approach For you, it was how can I live? How can I get to $100,000 of passive income a year? In order to do that, you need to have around one and a quarter or 1.2, something like that, million invested. You talked about not killing the golden goose, which is really key here, because if you sell that asset that's producing these returns, well, now you got to start all over, right? And then you got the tax situation, and we didn't get into that, right? So having these income producing deals is really key. You talked about it from a standpoint of investing for yield, and that's a really great strategy for people to have. You briefly mentioned kind of that rule 72. Can you just explain that a little bit more?
Yeah, so basically, you take your yield, say 10% a year, just for simple math. You divide by 72, and you get 7.2. What that means is if you are getting 10% distributions year over year, it's going to take 7.2 years to effectively double your original investment. So I look at this like, there's endless examples of stocks over the last 4 or 5 years, especially where maybe they were at a certain level in 2019, and then the pandemic and they were down, and then 2021 and they were up, and then 2022 and they were down, and then 23 they were up, and then it's just a roller coaster of speculation. So I don't play that game as far as I think this company is going to be here in 5 or 10 years, or this share is going to go from 10 to 20. I have no idea. And quite frankly, nobody else does either. And there's so many unforeseen events. So instead, I make an investment based on the cash flow performance. And if they've got a 10, 15, 20-year track record of paying consistent distributions or cash flow, I just look at it as how long is it going to take then for me to double my money through that, regardless of price appreciation, whether it's there or it isn't.
I love it. Very good and great way for us to think about it. You talked a little bit about kind of comparing the stock world to the real estate world because you got your license and you really learned the stock world. You had the background in real estate and you ultimately chose real estate. From your perspective, what made real estate more comfortable than the stock world?
Yeah, so I want to be fair to everybody here. I'm not suggesting like stocks are bad or don't do the whole Wall Street thing, but there were so many limitations to it. Starting with again the types of accounts that are out there for most people in terms of retirement. It's like, okay, you put your money in and you can't touch it till 59 and a half in a lot of cases, or you do this college account that has to be used exclusively for college purposes or schooling. And if you take this money out early, you're penalized. Plus, you're holding investments long term, which should be tax advantaged if you're doing it individually in cash, but instead you're getting taxed in some cases at ordinary income rates. And not a CPA, not a tax advisor, but you get the point, right? And then you have very limited control. There's been stocks I've invested in that have had an awesome track record, and then all of a sudden overnight, they're down 30, 40%, and it's out of your control, right? They're tied to kind of the macro cycles here. So here's what I love about value add real estate, which is mostly what I do. Now, it's mostly in multifamily residential, but it could be in other asset types too. As I mentioned before, you have ideally monthly cash flow distributions, you have equity upside potential. You're not just reliant on the market appreciation, but you're forcing appreciation by making properties newer, nicer, and safer for residents. And you have tax advantages at the same time. And it's far less correlated. In fact, it's hardly correlated to the broader indexes and stock market. So for those reasons, it just had a lot to offer. Whereas, I could go buy a bond, let's say, and yeah, it's got a mediocre cash flow, but limited upside. Or I could go buy a growth company and it might have some appreciation, but it doesn't offer me cash flow, or maybe a REIT, but it doesn't have the same tax advantages. So there's, each thing you look at kind of has its drawbacks. And then there's all the sales stuff with the whole life insurance and annuities. And again, I'm not saying any of these things are bad. There's definitely a place for these in portfolios depending on you and your individual circumstances. But for me, I kind of wanted that catch-all type of asset that just offered me the most amount of benefits with limited risk profile, so to speak.
No, I appreciate you sharing that. That's very helpful for us to break down. Like you said, for everyone, it's going to be a little different. I think it's based on your own background, your experience, your knowledge. But
Sure.
for you and your goals and chasing kind of that yield or looking for, the yield return, so you could make that transition, it makes sense why you took that approach. Let's talk about the work you're doing right now with Ashcroft, right? So you're the director of investor development. Tell us a little bit more about what that role entails.
Yeah, it's really evolved from helping Fairless, branch out with the investor relations arm. I was kind of the first guy to come into the company to do that role and take some things off his plate. Since we've built a full team of staff, I think we're 6 people strong now on investor relations. So I switched over to investor education, which is truly what I wanted to do from the get go. But business needs are business needs, and so with education, I did a lot of the podcasting circuit. I was the host of the Best Ever Show, which is Fairless's podcast. I did that for about 5 years, ran 2 complete 100-episode series there. And then I went over to investor development. So what I'm focused on now is running quarterly reports for our investors, pulling data from all sorts of reputable nationwide sources from CBRE and Marcus and Millichap, Urban Land Institute, the US Census Bureau, and on, and are just trying to articulate where we are in the economy and in this capital market cycle that we find ourselves in, and kind of the bull and the bear cases, trying not to be biased in one direction, but just paint the picture broadly of like, this is what I see and this is where we're at. Doing a lot more filming on our properties for transparency, offering up tours to our investors on the properties that we have to just show that this is a real thing. This is not just dollars and cents on a spreadsheet. This is a real business, and we're really changing lives and communities, and just developing investors. Because as you know, a lot of LPs are not like you and I. They're not real estate professionals by trade. They're going to be a doctor, a dentist, an engineer, an entrepreneur in a completely different sector. So there's a lot of education, perhaps that's needed, and I'm trying to fill that void in a very hands-on way.
No, I love that. You talked about the education, right? So looking at the different resources, you talked about the brokerage firms, Urban Land Institute, and grabbing data on top of the data and just understanding where the economy is, looking at your own portfolio, educating people what's going on with the properties, pictures, video tours, and just really helping to paint that picture of, hey, here's what we're doing with your investment. As the market's obviously changed a lot over the last year or so, and things aren't as, joyful, or I should
Yeah.
say sunny in general. So some of these updates are probably, not easy, especially when, distributions are paused and different things start to take place. How do
Yeah.
you manage those conversations with investors so that they, sometimes people aren't going to be happy, but on the same note, they know that you're doing what's right for the business?
Yeah, it's a great question. I think what a lot of operators were doing for years, and quite frankly, us included, was just sending you all the raw data. Here's our T12 spreadsheet. Here's our debt service coverage ratio. Here's our collection. Here's our occupancies. Here's our interest rates. Here's our, but again, back to the point of most of these investors are not real estate professionals, and so started getting a little feedback from investors as the economy has shifted and rates have come up, and to your point of pause distributions and all the rest, as to like, just break it down for me. Like, how are we doing? Like, what's going on with this deal? Like, shoot it to me straight. Give me layman's terms. It's kind of like a doctor giving you this in-depth analysis on something. It's like, dude, just, am I okay or am I not? So that's what prompted this level of transparency. And thankfully, we're in a position where we have enough staff to where I'm able to do these types of things. So that's really where it came from. And so to answer your question about the tough conversations, the best way I've found to approach it is, to try to create resources that match to different investor needs. So some of the engineer-minded investors are really diving into those quarterly reports and dissecting the data, but others are more of, the touchy-feely, what's the story here, and so that's going to be the film shoots that I'm doing and things like that. And so I like to back everything up with facts and data instead of hopping on a call and saying, well, this is my opinion, this is what I think. That only goes so far. If someone doesn't trust in you or your knowledge or doesn't know your background, then that doesn't go very far. So it's been very helpful to expand that way over the last 2 years, since rates have been coming up and the whole landscape has changed.
For someone who is a general partner and they need to have those kind of tougher conversations with investors or even just, provide a little bit more transparency, what tips or advice would you give them so that they can kind of continue to have the investors' trust on the execution of those properties?
Yeah, I'm a big fan and always have been of webinars and in person and live webinars with active Q&A and things like that. And what I've been doing this well before this market shift, is I offer up 15-minute calls all week long, all year long with anybody and everybody, Ashcroft or not, newbie or experienced, young or old, doesn't matter. And I do it, I give the option to do a Zoom call, straight from the same link. You can do a phone call or you can do a Zoom call. I find that the Zoom call is much more transparent. People can actually look you in the eyes. They can look at your body language. They can look at how you present yourself. There's a lot to that. So I would recommend that because some of the feedback I've heard from some of the other operators is, yeah, they're spitting out data, but you can't really get a hold of them. They're not being truly transparent. They're not hosting any kind of webinar. They're not really filling in. They're not really having the tough conversation. They're just saying, here's what's going on. Thanks for your trust. So I think there's a little more you could do for your investors, especially in times like now.
No, I think that's spot on. And obviously, you've done a bunch of podcast episodes and you've been recording a lot of information, trying to teach other investors and LPs what to look for and give them tips. You recently launched your Passive Investors Tips book. Tell us a little bit more about kind of this book and the information that investors will find if they check this out.
Yeah, I started podcasting with Fairless under the Best Ever Show with a segment called the Actively Passive Investing Show, which was the irony earlier in our conversation here of, you're a passive investor, but there's some active components to it. And what are those active components and how passive is it really? And those types of, themes and episodes. And then the feedback that I received over a couple of years of doing that show was, we love it when you get right to the point. Give us a tool or a tip or strategy or formula. You tell us what it is, how to apply it, why it's important, and how we can benefit from it. And so I started making these 5 to 10 minute short form episodes with zero fluff, getting right to the point. So I did 100 episodes of passive investor tips. That's what that became. And so I just this past week retired that series and stepped down as host of the podcast show because it's been a solo show. So you can think about 200 and some episodes of just you giving your content, right? There's only so much we have to give. And so I thought, the truth is a lot of people I've networked with over the years don't necessarily tune into podcasts. I think they're amazing, and I'm a huge fan of podcasts, but not everybody is, So I said, why don't I take this whole series that was frankly the most effective of any content I've made and make it a book? It's like a 185-page book, but it's really short chapters, 48 chapters that are like 2-3 pages, whatever it breaks down to. And as an ongoing resource for people, something you can easily refer back to. You don't have to get online and start searching for things and skimming through episodes and stuff like that. So that was the release and the making of the book. Very proud of that. And so, yeah, that's out on Amazon now. Passive Investor Tips is what it's called.
I love it. We'll make sure we put a link to that in our show notes so you can check out that Passive Investors Tips book written by Travis Watts. Travis, great information so far. We're getting ready to transition to our round of insights. But before we do that, if you want to learn more from Travis, you can go to his website. He's got a lot of great information there. Go to ashcroftcapital.com/Travis. We will definitely make sure we link to that as well in the show notes. All right, Travis, give us a failure or an apparent failure that set you up for later success.
Oh man, I'll give you great. It was one of my last flips that I was doing, and I think this was like simultaneously right as I was meeting the gentleman that I referred to earlier that had been full-time LPs, right? So I'm at the burnout stage. I'm doing my oil field job, 100-hour work weeks, no time for this stuff, and I just kind of got lazy or burned out. I don't know. This last deal, like I just did a deal to do a deal. Like I got tired of all the underwriting and analysis and assumptions and the what ifs and the stress. And I was like, whatever, I'm just going to buy this property. I don't even care, whatever. And so made an offer, 20% down, whatever. Well, the rehab went over budget. The market started to kind of flatten in this particular area. because oil and gas was starting to flatten out. Oil prices were falling. I chose a tenant that actually worked for my company, but I didn't know him, but that just kind of gave me some sort of instant rapport. And I thought, oh, you're trustworthy because you work at my company. Well, I didn't do a background check. I didn't do screenings. I didn't do a credit check. And these people moved in, and like from month one, by the way, this is how I used to do flips. Let me clarify this. I would renovate, I would rent it out for about a year on a 1-year lease, and then I would sell it. So it was for tax reasons. I would do like a delayed flip, so it wasn't a traditional flip. So they were moving in, and month one, they were late on the rent, right? They didn't have it right out of the gate. And then month two, they were late again. Month three, they just flat out didn't pay. Then they started acquiring pets, which, we had a 1 pet policy. It was a dog. Well, they had like 3 cats and 2 dogs. It was ridiculous. And then I hired a property manager because I'm like, man, I can't deal with this. The property manager put in 2 months and then they quit on me. And they said, well, this isn't worth our time either. And so anyway, long story short, I got them out a little bit early. And by the time I sold that property, it was basically a break even. It was nearly a year. And, again, you got to remember, I'm coming from like a state of burnout anyway, going into this. And that was just the icing on the cake. So between that deal, and maybe it was even a slight loss. I can't even remember. Like it was, I really didn't make money, and I put in a ton of time that I didn't have. That was really what shifted gears. And I said, I have to find another strategy. There is no way I'm going to get 50 or 100 single family homes and retire off this so-called passive income that was not passive at all. And so that's what prompted me towards the syndication route. And that was really the nail in the coffin, so to speak, with my active journey.
All right, give me a digital or mobile resource you recommend for your business.
Oh man, there's so many great ones. A digital resource. Wow, that's a tough question. My mind's going all over the place. I would say that we had this conversation a few years ago at the Best Ever conference, but I've found LinkedIn to be a tremendous platform to use for professionals, whether you're raising capital or networking with other investors. Of all the content, I've done experiments now for years, and I know you've had more success on other platforms than I have, but between Facebook and Instagram and all this kind of stuff, I've had next to nothing in terms of results, but LinkedIn has been powerful, very, very powerful, and not even with the premium and stuff like that. So if you're looking to network digitally, that's a great way to do it. And it tends, statistically speaking, it has the most high income, high net worth individuals out there using social media. So something to think about if you haven't doubled down your efforts on LinkedIn.
And it's certainly easier to prospect when you know at least the job titles and the companies people work for. So definitely works. Totally. Great platform. All right. Give me the book you've recommended or gifted the most in the last year, obviously besides the one that you just wrote.
Well, that one just came out, so I can't even qualify that one anyway. I have given out, I think, Tax-Free Wealth by Tom Wheelwright. That was one I read years and years ago. And I mean, I just applied probably 3 concepts from that book, this is probably 2016 when I first read it. And the cumulative effect from that book, right? I paid, $20 for the book. I've probably saved $70,000 to $80,000 in taxes just off of things written in that book. So I don't know if they have an updated version. Obviously the tax code's changing constantly, but that's been a great one. So, I always joke that I didn't get into real estate for the tax advantages, but I stay in real estate for the tax advantages. So that's a great resource.
Give me a daily habit that helps you stay focused on your goals.
Yeah, starting out the day, right off the bat, doing something healthy. Doesn't matter what that is for you. It's either, a protein shake or a quick workout in the morning. I like to sometimes drink celery juice, kind of clears your system out. Meditation, taking 10 minutes for yourself, going on a walk, going on a jog. Because the momentum is what's important. What I find with me anyway is if I start out the day on a bad habit, then I tend to just kind of give up consecutively after that. And it's like, well, I didn't even start the morning right. I didn't eat right. So might as well have a crappy lunch too. And then it's like, well, might as well eat a crappy dinner and just call it a crap day because that's just how it went. So starting out on the right foot makes a big difference.
It's a great tip there. All right, give me your number one insight for being a full-time passive investor.
I think I can is more important than IQ. I don't find myself to be a very intelligent person when stacked up against, academics or most people in general. But having that drive, having that belief, having that conviction, having that willpower to just push through, to just say it's real, it's plausible, I'm going to get there. Balancing kind of reading and education and mentorship with taking action. It takes a lot of internal drive to get to any meaningful goal. And I think that's probably the most important saying or quote or whatever you want to call it, mantra.
I love it. I can over IQ. I know you were out in Colorado. Where are you based now?
I'm out in Florida now, Central Florida.
Florida now. All right, Central Florida. All right, give me your favorite place to grab a bite to eat.
Oh, man. So we live in this little Disney-built community. It's kind of like a little Hollywood film set. People joke about it like it's the Truman Show or the Stepford Wives, but we love it. And it's got a lot of bike trails and ponds and water and very laid back, casual, quality of life kind of place. Well, we've got a downtown sector. And what I love most about it is there's no chains down there, right? There's no fast food and big brand names. It's all local shops. And so a place we like to go is called the Town Tavern. And it's just got a lot of great food. I mean, a huge 4-page menu of all kinds of stuff. And that's where we bring all of our company and guests. They got a great outdoor patio overlooking the water. And it's just a great setting. So if you're ever around Disney, Town Tavern.
Town Tavern it is. We'll definitely make sure we link to that and check that out the next time we're in Orlando. So great stuff there. All right. You gave us some great information, Travis. Just playing back, you talked about kind of your journey from an active real estate investor, doing flips, doing projects, getting a little burned out there, learning about passive investing, realizing that it's not just for the ultra wealthy, but everyday professionals can invest passively. You decided to become a full-time passive investor before working with Ashcroft Capital, which is a company you had worked for or invested in passively. Took all those skills and lessons and helping other people learn how to invest passively, educating them about deals. And I love the tips you gave us for those general partners, right? If you're actively managing a deal, make sure you're communicating to your investors, make sure you're sharing the information and breaking it down in a way that's simple for them to understand, not just a bunch of numbers and charts, but really helping them understand what's going on in the deal, what's going on in the market, so that they can feel like they've got a sense of knowledge going into that investment. Again, for those folks who want to learn more, you got two things. One, they can go to the website, ashcroftcapital.com/Travis, to check out some of the content you have there. But you also have your book, Passive Investors Tips, which is available now on Amazon. So we'll link to both of those in our show notes. Travis, always great to talk to you. Thanks again for coming back on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.